A gold fund can make money, pay you cash, and still leave its income promise gasping for air. That is the strange case on today's table. This fund has delivered a strong result since launch, yet the recent monthly checks look nothing like the opening act. The headline yield remembers a richer past. The current run rate tells a colder story, and beneath both sits a leveraged gold and options machine capable of moving much harder than a plain pile of bullion. So the key question is not simply, did it go up? It did. The question is whether the income an investor sees today is durable, or whether an unusually generous launch period created expectations the fund can no longer support. Today, we are dissecting the Simplify Gold Strategy plus Income ETF, ticker YGLD. This is not a conventional gold fund with a coupon stapled to the side. Gold itself does not pay dividends. To create cash flow, the fund has to manufacture it. The basic machine combines leveraged gold exposure with an options overlay. It seeks capital appreciation and income by taking more than a one-for-one exposure to gold, then using near-term, index-based put or call spreads and written calls. In plain English, the fund is trying to participate aggressively in gold while collecting option premium that can be distributed to shareholders. That combination matters because each part changes the ride. Leverage makes gold's movement hit harder. Options can turn volatility into spendable cash, but they can also surrender some upside, offer only limited protection on the way down, and make the payout depend on market conditions rather than a stable stream of business profits. That makes this less like owning a bar in a vault and more like running a trading desk around gold. The metal is the engine, the derivatives are the gearbox, and the monthly distribution is the output. But output is not the same thing as economic profit. This is research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold this or any other security. ETFs can lose value, and options and commodity exposure can add substantial risk. Verify the current prospectus, holdings, distribution notices, tax information, and other official fund documents, and consult a qualified professional before making financial decisions. Let's check the vitals as of August 14, 2026. This is an actively managed, commodities-focused ETF issued by Simplify. It launched on December 2, 2024, pays monthly, charges an expense ratio of 0.53%, and has $39 million in assets under management. There is no index listed as the thing it simply tracks. That distinction is important. A plain index fund follows a published recipe. Here, management is making implementation choices around futures, collateral, and options. Investors are not only betting on gold, they are also accepting the way the manager packages that exposure. This is a relatively young, specialized commodity strategy, not a decades-old core holding. Its operating history is short, so conclusions about payout durability must come from the evidence available rather than a long record across many market cycles. The honest income number to lead with is the current run rate, 12%. That annualizes the latest 4 payments and asks a practical question. If those recent payments repeated, what would a buyer at the current price collect? It is not a promise, but it is the closest number here to the fund's present income pace. The trailing 12-month yield is 23%, and that gap is not a bonus. It is a warning about the rearview mirror. The trailing figure includes older payments that were much larger than the recent ones. Advertising that historical rate as today's opportunity would be like quoting last year's salary after your hours were cut. It describes cash that was paid, not cash a new shareholder can assume will continue. There is another useful temperature check. Annualizing only the latest payment produces 9%. The most recent distribution was 28 cents per share. One payment can be noisy, so it should not replace the latest 4 average. But it shows why yield websites can disagree so dramatically. One may annualize the newest check, another may use a recent average, and another may total a full year that includes a very different payout regime. None of these rates is a bank interest rate. They are distribution calculations tied to a moving market price and variable cash payments. A high percentage can result from generous distributions, a falling share price, or both. The correct habit is to inspect the cash per share first, then ask what the portfolio earned, realized, or returned to make that cash available. Now for the history. The first 4 distributions averaged 91 cents per share. The latest 4 averaged 34 cents per share. The data's direction is unambiguous. The payout has fallen from the launch period level, with the recent average sitting at 37% of that first average. That does not mean every future payment must fall. Option income is inherently variable. Premiums respond to volatility, contract pricing, position size, and the manager's choices. Realized gains can arrive unevenly. A fund can have a strong month followed by a quiet one without anything being broken, but this is larger than ordinary month-to-month wiggle. The early cash flow established one picture of the product, the latest rows establish another. For an investor planning household income, the distinction is critical. A distribution history is not a paycheck contract. If the budget only works when the opening payments return, the plan is leaning on an outcome the recent record does not support. The charitable interpretation is that management is distributing what the strategy currently produces rather than forcing an unsustainable fixed amount. The harsher interpretation is that the launch yield created a powerful headline that could not persist. Both can be true. Cutting can protect capital compared with overpaying, while still making the fund unreliable for anyone who bought primarily for a stable monthly check. Now, we examine the price and net asset value path. The latest NAV or price is $35.45, compared with a launch reference price of $24.98. The reported NAV return since inception is 42%. Direction matters. This is growth, not erosion from the starting line. That positive path is a major piece of evidence in the fund's favor. Whatever concerns we have about the payout, the portfolio has not simply mailed shareholders their own money while the starting value steadily disappeared. Gold exposure and the trading structure produced meaningful appreciation over the period covered by the data. But the rout was violent. The maximum drawdown was negative 46%. That tells us an investor could have watched a large part of the position's value vanish from a peak before recovery. Monthly cash does not neutralize that experience. If someone needs to sell during a deep decline, later recovery is academic. And because this strategy intentionally seeks amplified gold exposure, a rough move in the underlying commodity can be magnified before the option overlay helps or hurts. The lesson is that a rising endpoint and a dangerous path can coexist. The endpoint rewards patience. The drawdown tests whether the investor actually had the risk capacity to remain patient. For a commodity income fund, both belong in the diagnosis. Distributions only become meaningful when we place them beside what happened to capital. Since launch, the fund has paid $8.66 per share in cash distributions. Using the simple distribution inclusive measure supplied in the data, the total return since inception is 77%. That is a strong outcome. It also prevents a lazy conclusion. This is not a case where a flashy payout concealed a losing investment over the measured period. Shareholders received cash and ended with appreciation from the launch reference. Still, total return and dependable income answer different questions. Total return asks what wealth was created across price change and distributions. An income plan asks whether future cash flow is repeatable enough to fund spending without forced sales. A fund can pass the first test and fail the second. That is exactly the tension here. Compared with a plain gold position, this structure adds a stream of cash and a much more complicated return path. The fair comparison is therefore not distribution versus no distribution. It is whether the added cash, leverage, fees, option outcomes, and drawdown behavior leave the investor better compensated for the extra moving parts. Here is the operating table. The disclosed holdings show gold 100 OZ Futter OCT 26 at 97%, the Simplify Government Money Market ETF, S-Bill, at 47%, BGOVT at 44%, plus 2 call options the fund writes for premium income. Those percentages exceeding a normal fully invested portfolio are not a typo to be casually added as if these were ordinary stock positions. Futures create economic exposure without requiring the full contract value to be paid upfront. The money market and government positions can serve as liquid collateral and reserve assets, while the derivative book carries the gold exposure. The fund's stated aim is 150% gold exposure, so it is deliberately designed to behave more aggressively than a simple one-for-one gold holding. Start with the future. A gold futures contract gains or loses value as the price of gold moves. The fund does not need to stack physical bars in a warehouse to obtain that exposure. But futures must be managed over time as contracts approach expiration, and their results can differ from the spot price investors see quoted in the news. The supplied data does not quantify those implementation effects, so we should not pretend to know their size here. We only need to understand that the portfolio owns a derivative claim on gold's movement, backed by a large collateral sleeve. Then come the options. When the fund writes a call, it receives premium upfront. Think of that premium as rent paid by another trader for the right to claim some favorable movement under the contract's terms. If gold is flat, choppy, or rises only modestly, collecting premium can add income. If gold surges beyond the relevant strike, the written call can give away part of the upside that an uncovered position would have kept. If gold drops sharply, the premium is only a cushion. It does not magically cancel the loss from the leveraged exposure. From here, watch the cash, the capital, and the contracts as separate lines of evidence. First, track each new distribution in cents per share and update a recent payment average. Do not let a trailing website yield carry launch period payments forward indefinitely. If the recent checks stabilize, the present income case becomes easier to evaluate. If they keep stepping down, the original income story continues to weaken. Second, compare distributions with the NAV path. A payment is healthier when the portfolio can distribute cash while preserving or growing value over a useful period. If cash keeps arriving, but NAV begins a persistent decline, inspect the fund's distribution notices and tax reporting for return of capital treatment rather than assuming the payment was earned income. Third, inspect the leverage and option book in current holdings. The stated target describes intent. The live portfolio shows implementation. Changes in futures exposure, collateral, written calls, or spreads can materially change how the fund behaves even when the name on the label stays the same. Fourth, compare the fund with the simplest alternative that matches the investor's goal. Someone seeking gold diversification may prefer a plain exposure without an income target. Someone needing dependable spending cash may prefer assets whose payments arise from contractual interest or recurring business cash flows. This fund is most coherent for an investor who specifically wants an actively traded gold strategy and can tolerate variable distributions and large swings. Finally, watch the fee alongside outcomes after distributions. Complexity has to earn its keep. The proper scorecard is not whether the fund mailed cash, but whether the entire package, capital change, cash received, risk taken, and tax character, beat the alternative the investor could actually have owned. On life support, that verdict applies to the income proposition, not to the fund's entire investment result. The measured total outcome has been strong, and the NAV finished well above its launch reference. Those are real positives, and they keep this from being a simple failure story. But the product invited investors to expect income, and the distribution record has contracted severely. The recent cash pace no longer resembles the opening pace, while the drawdown shows that this is not a gentle substitute for ordinary monthly income. A successful gold trade can coexist with an unreliable paycheck. The fund may fit a risk-tolerant investor who wants amplified gold exposure and treats distributions as variable proceeds, not household income certainty. It is a poor fit for someone who needs the old headline yield to fund fixed expenses or assumes monthly payments make commodity leverage conservative. The conclusion: the patient made money, yet the income pulse weakened. Until recent distributions demonstrate durable stability without sacrificing capital, treat the payout as conditional, not dependable. 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button. It genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next, and where do you think the real risk is hiding? We read everyone. Thanks for watching.